Yeah. This was a listener's question. They provided a couple points, which I'll just really paraphrase their question. They've been holding it for a couple years now. It's had a loss. The stock has really been coming down. They're wondering if they should double down on it. So if they should re-up their position, because obviously it's decreased. The stock has been slammed as there's been delays in growth, but he sees a growth in backlog with a further catalyst once the one gateway, a new product, hits the market with a massive total addressable market to support their growth pathway. But this is also all on the back of management claiming that they will hit break even in quarters, not years. So let's get into this company. The Xtract One, symbol XTRA on the TSX, is a provider of AI-powered security systems to detect concealed weapons in real time, looking to replace metal detectors, increasing patron throughput and reducing operating costs for a venue, so like a sports venue. Instead of going through a traditional metal detector or them waving you down with a wand, you can walk straight on through. It's easier for patrons to go through, and then it looks at the if you have a weapon concealed or not using AI to, I think it's to detect a certain response you get from frequency waves. And then the shares are trading at 34 cents a piece at an $80 million market cap and are down 53% over the past year. So there's your decrease for the past year. It's quite big to say the least. We'll start with a look at the last quarter, fiscal Q3 2025, and this is the end of April 30th, so it's an offset fiscal year. So for the 3 months, revenue fell 26% to $3.5 million compared to $4.7 million the prior year. Management is attributing this to delayed deployments. Given the contract nature of deployments, quarter variation is expected, really, with any business that does deal with contracts, especially upfront contracts, which about 2/3 of their revenue is upfront payments, with about 1/3 being subscription based. And you can see 9 months as well is slightly down, but not anywhere near the same degree. I'd just call it up materially flat for a company with this much fluctuations on the 9 month. But zooming out, we can actually see revenue growth has actually been significant over the past few years. And it's really just been flat this last year. Gross profit fell 27%, so slightly more than the revenue, to $2 million from $2.7 million, and gross margin got a haircut to 57% from 58%. Net loss decreased further to a loss of $3.1 million from a net loss of $2.7 million, or a loss of 2 cents and 1 cent per share, respectively. And contractual backlog as well, it has increased to $15.4 million from $13.8 million. As well, the company noted that the Xtract One Gateway, that's their new product, was looking to ship in July, so this month, with aggregate orders of $6.7 million across 5 customers, which should give a bump in the coming quarter and quarters. Whether or not that comes to fruition, that's a question for management, not for me at this time. As well, the company has $21.1 million in signed agreements that are pending installation, so that's a further backlog on top of that $15.4 million, on top of that contractual backlog. So shifting to its balance sheet, it's net cash. And then in the quarter, the company had $1.9 million in cash and equivalents with no debt and lease of $1.1 million. That's not bad at all, but the balance sheet does not really have any leeway, given the company has been burning cash, with $2.2 million being used for operations before working capital over the past 3 months, and $5.4 million for the past 9 months. You're looking at somewhere around a $2 million a quarter in cash burn rate when you're not worrying about the working capital fluctuations, meaning the company needs to get more cash within this quarter, which they did. They raised $6.5 million after fees at 39 cents a unit, 18 million units, which includes a share and a warrant exercisable at 49 cents a piece. If the warrants are not exercised, that's about another year of cash burn at the current rate. With the warrants being exercised, that period a bit over doubles. But the shares would need to appreciate before that is likely to happen, because obviously you're not going to exercise a warrant if you can just buy the shares cheaper. And as you can see with the chart I have up, the company increased the share count significantly over the past few years as the company has not been profitable. And this is the issue with pre-profit companies. They do have limited time before needing to raise. The concerning part for Xtract is that the company has stated it's been progressing towards cash flow break even since at least fiscal Q1 2024. That's the farthest back transcript I could find for the commentary. And that just hasn't materialized. Revenue has grown significantly, but the losses just haven't contracted yet. It hasn't neared that break even. Quickly, valuation, as the company isn't profitable, we need to go off revenue, which is at 5 times trailing. This isn't a super discount valuation by any means. It is supported by the expectation of significant growth when you are getting those revenue multiples of 5, 10 times, you do need growth. It's just the reality of the scenario, which does add further risk if growth does not materialize or not at a quick enough rate, which is why you've seen the stock really get hit as these delays have been occurring. And as the question mentioned it, a quick look at the total addressable market, or TAM, as the question highlights, it is big. The initial focus is $4.6 billion, and this includes stadiums, theaters, event spaces, and casinos, with expanded TAM of $39.5 billion and a global TAM of $135 billion. That's a massive total addressable market, but just because the market is big does not mean the company has a clear runway to these billions in revenues. You'll see these pretty common for pre-profitable and pre-revenue companies. They'll have these massive TAMs, or they might call it like a serviceable addressable market, some variation of addressable market, and it will be a big number. That most of the time they're not going to be able to get anything, even a percent of that. It's very big, and they purposely do that. And as further really evidence of there's direct competition in this space, Xtract is direct competition. Evolve Technologies, another public company, EVLV on the NASDAQ, offers a similar solution. AI weapon screening, SafePoint, which is owned by SoundThinking, Simple SSTI on the NASDAQ, which also offers AI-based weapon detection solutions. So you're not the only player in the market. So even though the market is big, in your niche in the market at this time, obviously they can expand into different areas. It is competitive at this time, and it does make these pre-profitable companies is harder to compete, because obviously you're going to be competing not just technology, but also price at the end of the day. And if you are competing on price in any manner, you have to obviously lower your revenue, and that's harder to scale as quick. Overall, Xtract just does not check the boxes for Keystone this time. It's not profitable and it's still burning cash. And the gap towards closing that negative cash flow hasn't really occurred at this time, despite the management moving towards it for a while now. It isn't appearing in the financials this time. That's something which we really be watching for. Is there an actual trend to what they are saying, which there just hasn't been so far, at least. While the balance sheet in isolation, it's good. The cash burn just eats away the capital, causing the need to raise cash through equity, like we have seen very recently, just in June, which ultimately dilutes shareholders. But there is no debt burden, which is nice to see. Sometimes for these early pre-profit companies, you start to see them take on debt, and they're just never able to overcome the debt, because you'll be seeing them high single-digit, low double-digit debt rate or interest rates, and it's just really hard for them to overcome it. So nice to see that they at least don't have debt at this time, but they are raising through equity. The one gateway product solution, likely having shipped or shipping in the near future, can provide a growth runway, which we can see in the notable backlog, but with delays could push out any potential growth further. The adoption of one gateway will be something to follow in the coming quarters, and that's really, if you are an investor or prospective investor in the company, you want to see how that uptake occurs. Does it actually follow through with what they are saying at this time? And is it eventually profitable? Because right now they're early units, you expect lower gross profit margin. Does that gross profit margin expand over time, or does it just stay flat or decline even? And just circling back to the initial question of doubling down on a losing position, Xtract doesn't meet our GARP criteria, obviously, for investment. It never has, given it's not profitable. But I will speak a bit more generally when looking at a company that has fallen in price. A couple of simple questions you can ask. Does the company still meet your original thesis of why you invested in it, or has that original thesis broke down? You'll see many times in these early tech startups, or even something Xtract is a bit more progressed than some. Are they hitting their mark? Is the reason why you initially invested, is it because the technology is able to do X, Y, and Z and get to the market at this rate? Is that your thesis? Did they follow through on it? Does that still exist? If you have, then the next question is, if you have no position in the company already, would you invest in it at this time? If the answer is no, you probably just want to close out the position. If you're thinking, yes, I still want to invest in this company, I think it's still great, it's just not recognized by the market, it could be time to invest more. But obviously for us, Xtract does not meet that criteria at this time. And I'll pass that off to you guys if you have any comments.
Definitely.
Yeah, the fact that you have any shares in any individual company should have zero bearing on whether or not you're going to invest any more in that business. And that's, people get in that trap of doubling down. Oh, I can lower my average cost. So it biases towards investing in that company. You should look at that business with fresh eyes. If you wouldn't invest in it now, do not invest because you're doubling down or lowering your average cost. So, I mean, it's just general on any company. That's not on this company specifically, but you know, you got to look at would you invest in this company now outside of whether you hold any position whatsoever?
Yeah. And like, yeah, it's an interesting technology, but again, it's a story at this point. And like Brett was saying, like we need to see management, execute. Like for example, like look at NTG Clarity. We covered it on the podcast a couple times. They started actually like really hitting numbers, and we were seeing it. We spoke with management. They said that there was going to be, a potential, further, they were going to be able to replicate this going forward. That's what we would like to see first before, a recommendation, or obviously, when it comes to this individual, do you dollar down?
Yeah, NTG, we waited till it had significant earnings, right? And then, trading at 78 cents this time last year, sold half our position at 230, 240.
Yeah.
Like that, it's always a misnomer thinking you got to get in before the company's profitable. And that's what people might say with an Xtract, right? I'll get in before it's profitable, then it'll cross that line. You're talking about 200% in a year on a company that already was profitable and was going to increase profitability. That is investment versus this is more speculation. Also, if you look at Xtract 10 years ago, 3.4 million shares out. Today, 218 million shares. Even if you just look back like 5 years, 140 to 118, just a huge increase every year because, if you don't have cash flow, you have to fund yourself either going into debt or issuing shares. This company continues to issue shares. So it's hard to make a per share earnings now for this business on its revenue level, even if they increase it significantly with over 218 million, plus further dilution likely coming from warrant exercise if they do exercise. I'm not certain at this point, but yeah, my 2 cents.